All right. So thank you guys so much for your patience. Thank you for joining us today. We're really excited to have everyone both in person and virtual, and maybe watching this later on this recording. This is a great opportunity to hear from one of our amazing dual alumni, both Rollins and Crummer, who's gone on to do some amazing things. So we have Cameron Dawson as our guest today. And so this is kind of a joint meeting between the Crummer Alumni Association and the Crummer Finance Organization. And so we're really excited about the opportunity to hear some of her backstory and get the opportunity to engage with her. The chat box for those of you guys that are on Zoom is your opportunity to chat with each other, also provide any questions for the Q&A session. And so with that being said, I'm going to kind of jump into a really quick introduction to Cameron, and we'll get into a lot more of her backstory through the conversation. But she's currently the Chief Investment Officer at NewEdge Wealth. Like I mentioned, she is both a Rollins and Crummer alum, so Rollins 2010 in economics and dance, a very unique combination I'm sure we'll be hearing more about. And then she came over to Crummer and was a finance concentration, graduating in 2012. Previously, she was Senior Equity Analyst at Bank of America, Chief Market Strategist at Fieldpoint, and as I mentioned, she's now CIO at NewEdge Wealth. You've probably seen her on many of the media opportunities she participates in on CNBC, Bloomberg. I know she was mentioning she was on Fox this morning, so lots of great opportunities. And so with that, I'm going to introduce our moderator for today, which is our current Crummer Finance Organization President, Davis Mosher, and he's going to continue the conversation with Cameron, and then hopefully at the end, if we have some time, we'll do a short Q&A session as well. So Davis, if you want to go ahead and come on up.
So good afternoon, everybody. Thank you so much for joining us today. Personally, I've been looking forward to this event for so long, so it means a lot to have everybody here, especially you, Cameron. Speaking on behalf of so many current students, alumni, and professors, we're really just so proud of you, and you're a truly inspiration to see one of our own really making it at the pinnacle of finance. And it means the world for you to come back and join us here today. So thank you very much for joining us.
Well, thank you for having me. I can't tell you how much of a thrill and an honor this is. I mean, to think that just shy of 15 years ago, I was sitting in that very room in Bush Auditorium doing my first kind of orientation sessions when I joined Rollins, and just absolutely wide-eyed, not knowing what I was going to do with my life, knowing where I was going to end up. And so to be here, getting to speak with you all today, I think is just such a great honor. So thank you.
Yeah, absolutely. And you've obviously come a very long way, but there's a little bit more interesting stuff about you underneath the hood that many don't know about. Would you mind telling us a little bit about yourself before you got to Rollins, growing up? Who was Cameron Dawson and what were you interested in?
Yeah, I'm born and raised in Orlando in the Dr. Phillips neighborhood, so not too far away from Rollins. Since I was very young, I was incredibly passionate about dancing and the arts. I played clarinet as well. And when I was 15, I said to my parents, I want to dance full time. I want to do ballet full time. I want to pursue a professional career. And somehow I convinced them to let me leave traditional high school, homeschool myself online, and then dance with a ballet company down in Miami, and really danced with some of the best, greatest dancers in the world. I had lots of injuries during that time and kind of hit a wall when I was 18, realizing my body just couldn't do it. And very last minute, I decided to completely change course. I said, Mom, I want a normal life. And she thankfully had made me take the standardized tests and made me sign up for online classes at UCF. And I got to UCF and I had this wonderful professor by the name of Dr. Vladimir Solinari, who pulled me aside and said, you need to go to a small school and get a liberal arts education. You have to do that. And so I said, I don't even know where to begin. And a friend was going to Rollins at the Holt School and said, you should come just take a tour, speak to people. And I went and met with a bunch of the administrators and said, I have to do this. But I was a transfer student who didn't you really qualify for any scholarships. And so I ended up doing my undergraduate fairly rapidly in 2 years once I transferred in. And then I had another good friend who said, well, you should think about going to Crummer and staying and doing the 3-2 program. And I ended up graduating outright, but that 3-2 program then led me to staying and doing Crummer, which kind of helped, satiate the desire that my time at Rollins really wasn't done.
Yeah, and not only did you just go to Rollins and Crummer, you graduated as the valedictorian of both graduate classes, which is incredibly impressive. What would you say are some of the keys to your success? How did you figure out that you had this interest in finance? And tell us about your time here at Rollins and Crummer.
Yeah, maybe I had the great benefit of living at home when I was an undergraduate. So I've always been very disciplined, and that is something that, to my detriment or to my benefit, that I, and my parents will note this, is that I'd always say, well, how do I become the best at something? And I would kind of, lock into pursuing that. And oftentimes I wasn't the best, or, rarely are you, is that possible? But I had said, I remember, I remember asking the question, what would it take to be valedictorian of the graduating class? And it was done by GPA. And I said, okay, done. That's what I want to do. And it was such a huge honor, mostly coming from just a short time before, when I didn't even think I would be any good at school. I spent time homeschooling myself online through high school. I didn't go through your traditional channels. But I had these professors that sparked a love of learning in me, that I knew that if I put the effort in, that I could be good at this process of the work and the study. And so I was really fortunate to find myself in an area that really sparked my passion. That I think when you have passion about something and you're willing to work hard, that's where you can excel. And I owe it to May Fitchett, who's part of the counseling team, who sat me down and said, I think you should do this. She's the one who actually told me to be an economics major. So I think I probably owe my whole career to her guidance. She was my biggest champion from day one, even when I didn't believe in myself. She was huge. And same with the professors. I was just so fortunate to get to study under such supportive and inspiring people. And I know that sounds trite. It can sound true, but every day there is something that I come across that is outside of my realm, my study of finance, that I go, I first was exposed to that at Rollins because of the liberal arts education. Whether it's saying, some science paper, I was talking about behavioral economics with a client. I was talking about philosophy with a different client. These things that you don't think are important all of a sudden become very important when you're trying to have a holistic worldview.
Yeah, absolutely. And personally speaking, I can attest that one of the main reasons why many of us came to Rollins is to get that personalized, customized education and grow real strong relationships with our professors and administrators. And also get the opportunity to participate in some really unique projects and events such as today. Are there any outstanding projects that you can think of at your time at Rollins that you have really brought with you forward?
Well, I think the first ever security analysis project that I did in Dr. Singleton's class, when it was so bad that he didn't even bother giving it a grade, he just said, start again. And I remember the hours that I spent in his office going, I want to understand, but I don't understand. And it's such a different way of thinking about the world when you're approaching things from a financial perspective. And it was so powerful for me because it was a huge challenge. And at that point, it was in my second to last semester at Crummer. I still didn't know what I wanted to do, but I just knew I didn't want to be bored. And meaning that I wanted something that it would take me a really long time to be proficient and good at. And I remember my team members in that first class and on that first project, knew so much more than I did. And I just said, okay, can you teach me, please? And I was immediately hooked, though. I said, this is what I have to do. It's essentially economics applied to the real world. That's what finance is. And so that first project was so incredibly transformative. Now, the other thing I'd say is that my time dancing on the Annie Russell stage made me into the person that does my job today, because I got to constantly be in front of an incredible audience of the Rollins community and dancing. We had a partnership with Valencia College at the time, and getting to dance amazing choreographed works from the staff, but also from choreographers like Alvin Ailey, and getting to perform them on the Annie Russell stage. And now today in my role, I get to have both, which means that I'm using all the skills I learned from Dr. Singleton, and now I'm getting to use all the performance skills that I learned dancing on the stage at the Annie Russell. And I have to say that is the coolest thing, to feel that full circle and really engagement of both sides of who I am, which is both analytical and an artist.
Yeah, absolutely. And my mother, who's watching today, was also a ballet dancer, so I've always had a very strong appreciation for the grit needed to perform at the highest level in the dance industry. We actually have a beautiful new theater here we've just constructed, so maybe you could give a little guest appearance sometime.
Yeah, well, I always say that studying for the CFA was easy after I had shoes thrown at me when I did something wrong after 12 hours of dancing, you know. So it kind of puts in perspective that discipline, and you know, the CFA study was difficult, but it was not more difficult than rehearsing Giselle. I'll tell you that much.
Yeah, so you've obviously faced your fair share of adversity and persevered through. Tell us how that has translated directly into working in one of the most competitive industries in New York City, and what's that like?
Yeah, finance is an intense world. It's a very competitive place, and I've been very fortunate along my career to work for really great bosses who've been my advocate all during my time. I spent about 8 years, a little over 8 years at Bank of America. And all through that time, having fantastic mentors that really have stayed as really big parts of my life. But even with that, you are constantly fighting for performance, meaning that it is a meritocracy. Either you make money or you don't. Now in my world, you're constantly trying to have market calls that are relevant and actionable. Sometimes you're wrong, sometimes you're right. The lesson is, when you're wrong, you either cut the loss sooner than later, or you realize when you need to double down, and that's a tough decision always. But I think the discipline remains really important, because as I mentioned before, if you can combine a certain prowess for something with a lot of hard work, I think that's where you have the ability to excel. And for as intense as it is, it's so exciting because you get to learn from really smart people. I'm surrounded by people that I constantly, I'm like, how'd you get to be so smart? And I think one of the lessons I learned early on is that in finance, and I think anything where you're trying to make projections, is that you're never going to know everything at all times. And so if you can never know everything at all times, it means that you have to trust other people with their opinions. And the best way to trust people with their opinions is not to necessarily just take the conclusion, but to understand their thought process, meaning that I know this analyst does really great work on X, Y, and Z stock. I might not agree with his conclusion, but I know his process, which I can incorporate into my process. So I call it standing on the shoulders of giants, meaning that you have to be able to have that appreciation for where people have great expertise and how you can then build upon it to see further, because you always get into information overload or the paradox of choice, meaning that there's just too many options and directions you could go. And so the way you do that is you filter, kind of leaning on people whose process that you trust.
Yeah, that's amazing. And coming from Rollins, we have so many incredible alumni across industries, but not as focused specifically in finance in New York City. But just to carry that grit with you forward and to be able to learn from mentors is essential. You mentioned Dr. Clay Singleton, who is no longer with Crummer anymore, but who are some other mentors that really meant a lot to you with your time here?
Certainly, Dr. Voiku, who's heads up the Women in Finance and works with Trace on that, is always been a huge supporter of mine. Dr. Sherry, who passed away a few years ago, was a huge supporter and mentor of mine. Dr. St. John, he's I think a couple of floors upstairs in the psychology department, was fantastic in helping me realize that I could learn things quickly. I'd never taken, it was a physiological psychology class, and we were dissecting brains. Never had studied anything like it before. And I did well on his first test. And he's like, you should be a psych major. And I said, well, I can't stay. I'd love to, but I can't. And it proved to me that I could learn quickly. And that, I think, is one of the greatest traits that's what you learn with a liberal arts education, and it should never be downplayed. You're never going to have all of the knowledge and skills in order to succeed at whatever new role or job that you're doing. You'll never have the perfect resume. But if you can prove to yourself and your potential employer that you can learn quickly and that you have the skill set to pick things up in a rapid way, then it doesn't matter if you're not perfectly qualified. I haven't been qualified for any of the roles that I've had. And it's constantly been drink from the fire hose, learn as much as you can, and move as quickly as you can in getting up to speed. And I think, when I draw it back, it's those classes where they were off piece. I had to kind of like check the box and it was like the alphabet soup at the time. I had to check the box, and that forced me to prove to myself that I had the capability to learn quickly. And then I can never forget Dr. Yellen as well, a math professor who just was my champion from early on. I hadn't taken I taught myself calculus in high school online. That hardly counted as a real math class. So remember, I came into his class, I was like, ended up loving it, and would have been a math major if I had the time to stick around.
Yeah, that's awesome. So there are many students with us today, including a bunch of young women. What would you say to the young women who are in the crowd today who are interested in pursuing a career in finance?
Do it, and embrace the fact that you are different. It is so powerful, daunting, but powerful to walk into a room where it's a sea of 40 dudes and you. Because if you are different and then you happen to be good, everybody remembers you. And when people remember you, then it's like smooth sailing. You get this wind at your back because you're not constantly having to fight for attention. So I covered industrials for a while at Bank of America, and industrials being like machinery companies and aerospace and defense companies and truck companies. And I went to a trucking conference in a suit, which I probably should have chosen a different outfit. I did not fit in. However, that experience of being one of only a handful of women, I never saw as a headwind. I saw it as my greatest tailwind. Now, I had to earn a seat at the table. I had to earn respect from people, because the number of times that people assumed that I was just this like junior intern filling in, and they jumped to the conclusion, and then you hit them with the zinger of a question. But being underestimated is fantastic. And I don't think that necessarily I was underestimated because I was a woman, but I do think I did look different at the end of the day. I didn't look like everybody else that was covering these sectors. And like I said, I think that was my greatest benefit. So seek out where you're different. Don't, if you're a research analyst, don't cover things where there's a lot of women covering the stocks. Cover, I don't know, gas utilities or oil and gas exploration and production company. Like, do something where you can stand out. Because like I said, if you can stand out and be different and be good, it's really powerful.
That's awesome. That's super inspiring. So I would like to learn a little bit more about your current position as the Chief Investment Officer at NewEdge. Could you tell the audience a little bit about specifically what you do on a day-to-day basis, but also from a general perspective?
Sure. So it is an incredibly exciting role. So the company is about 2 years old, and we are building and have built the what we think to be the preeminent wealth management platform for as an independent, meaning that we're not part of a large bank or organization. And my role is to oversee the investment platform and shape our market views and how we're investing for our clients. So I spend a lot of my time doing operational things, building out products and businesses, but I also spend a lot of time rebalancing portfolios, making investment calls within the portfolios. We manage a lot of the money in-house, internally. And then I spend, of course, a lot of time writing and thinking and coming up with those market views. And then the last portion of the time is speaking about those market views to the broader outside world. So it's an incredibly demanding job, by far the most demanding job that I've ever had, but it's been really fun to build out not only the writing and the thinking and the speaking portion of it, but the operational side, and really getting to be a part of building a business, which is exciting because we're building something that is unique, like I said, in the marketplace.
Yeah, awesome. And just to provide some perspective, would you mind telling the audience like the size of the fund that you manage and what it's like to be in charge of that much capital?
Yeah, it's super fun in a bear market. Last year was of course a challenging year for markets, and part of the role that I play. I often say to advisors, we have 2 jobs and 2 jobs only as advisors of people's wealth, which is that we don't let people buy at the top and we don't let people sell at the bottom, because both of those actions have the potential to really destroy wealth or make returns really low. So what that means is that we have to, we're never going to know exactly where the top or the bottom is in any market. They say, nobody rings a bell, which is true. You never know. However, you can, I do a ton of analysis that I call it the multidisciplinary approach. So a lot of strategists will focus on one school of thought in order to come up with their worldview. So they'll say, I'm a technical analyst, or I am a macro analyst. I only look at economic data. Technical analyst, sorry, just for clarification, is when you look at chart data, looking at volume, price momentum, doing a lot of seasonality work, that type thing. And then the macro analyst, a micro analyst who does all fundamental bottoms up analysis, and then a quantitative analyst that just says, I'm going to download a bunch of data from the market and figure out what works. Quants, that was by no offense, because we have a lot of quant work that we do. But this ability to go in and use all of these different schools of thought to get at a worldview where it's always about the confluence of evidence. There's never just one thing that is the be all and end all data point, but it's about weighing all these different cross currents and saying, on balance, on net, this is where I think the world is going. And it's also balancing different time frames as well. So for example, in the short run, you can have a call that the market's going to go up, for example, but you could still be kind of negative in the long run. So here, just as an example, during the 2000s, we had a big, huge bear market, down market in US stocks, primarily in tech stocks with the NASDAQ. The NASDAQ declined over 70% during that time, almost 80% of a decline over 2.5 years. But over the course of that 80% decline, there were 5 periods of rallies of over 30%, one as high as 50%. So when we think about being strategists, we always have to have this vision in our mind of where you are on not just the short term, but also on the medium term, because you can see the market move against you on a short period of time. You could still be right over the medium term as well as over the long term, but you have to realize what different drivers are driving markets over these different time frames, which just means you have to have a very broad view about all these different schools of thought, all the different evidence to feed in. And then some of it is a gut. It's an art. It's, you'd like it to be a science, and it would be nice if it was a science. They call economics the dismal science. I wonder if it's like finance is like the dismaler science, because we don't even get it never is a clear black and white, except for in hindsight, right? Of course, you get the market being your weighing machine and voting machine, to quote Jeff Bezos. So I think at the end of the day, it's a powerful ability to be and have this broader worldview, because you can't just look at one school of thought in order to come up with where you think the world is going. Oh, and you asked a question, the size. We're about $9 billion in our wealth management business, and about $32 billion overall in our broader business.
Wow. You have been quite outspoken and often have gone against the grain when interviewing on CNBC or Bloomberg, and they've asked you back multiple times, for a reason. I think you gave a lot of the tough love to the market that it needed. Could you tell a little bit about your current market outlook, where you think we're at right now, and where we may be going?
Yeah, sure. So just as a testament to the liberal arts education again, the title of the outlook this year that I did was a Goethe quote, which was, "Enjoy what you can, endure what you must," which just means that there are going to be market opportunities that present themselves, but a lot of the same headwinds that we dealt with in 2022 are likely going to be challenges for 2023. So what that means is that inflation likely moderates, but it doesn't moderate back to a level that the Fed says we can call the all clear, everything's fine, water's clear, don't worry about the sharks. That likely doesn't happen just because of what we see in the underlying inflation data, which means that the Fed likely stays tight. We thought that it's unlikely or much less likely than the street expects that we go into a recession this year. If you see this morning, we got retail sales data, and it was the strongest in multiple years, up 3% versus estimates of up 2%. So really showing a reacceleration in the economy, which just means that it gives really the Fed no reason to dial back on its hiking path. So the end result is that if we think about the two major components of what drives equity prices, you can put them into two basic buckets, which is earnings and valuation. And in Finance 101, you learn in market analysis that the price of the index or the stock is its earnings multiplied by its PE multiple. And so if we think then those two components, what drives both of those? Well, on the earnings side, of course, it's economic growth. If we don't go into a recession, it means that those estimates for down 20% earnings this year, they're likely too bearish. But what's interesting, what we've seen in this earnings season thus far from the fourth quarter and in outlooks, is that we're still seeing revenue growth because we're not going into a recession yet. However, we're seeing margins fall, margin compression. If you walk your way down the income statement, even if you have revenue growing, but your margins are compressing, you're making less money for each dollar of revenue, and result is earnings are declining. And so what you're seeing is offsetting of all of that revenue growth with falling margins. So we've been saying there is potential that we could have an earnings recession and not have an economic recession, meaning that earnings come in flat to slightly down, even though we don't fall off a cliff from a growth perspective. So we'll be watching all those dynamics closely on the earnings line. Then we shift over to the valuation line. This is really important. Valuations are driven by a lot of things. They're driven by sentiment. You see valuations go really high when you have big bubbly bull markets like we had in 21, as well as back in the tech bubble. But they're also driven by interest rates and overall liquidity in the market, meaning that lower interest rates and very abundant liquidity support high valuations. High interest rates and very tight liquidity put downward pressure on valuations. The peculiar thing to start this year is that at the beginning of the year, we started seeing signs that interest rates were falling and the bond market was going, hey, Fed, we think you're going to cut rates and you're going to become easier with policy. But then we've gotten hot inflation data, hot employment data, hot retail sales data. And guess what? The Fed's coming out and saying, I don't know what you're thinking, but there's no way we're cutting rates. And so what's happened in the last 2 weeks alone, the bond market has woken up to the Fed saying, don't expect us to cut. We are going higher for longer. The bond market's waking up to that. You've seen this big spike in yields, big spike in expectations for Fed funds pricing. But the equity market hasn't caught up to that because the valuations are still really high. So right now, the valuation on the S&P 500 is at about 18.6 times forward earnings. So on the next 12 months of earnings. That 18.6 times is at the peak of where we reached in early 2018, as well as early 2020. Those were both periods of really strong markets that were boosted by good economic growth and somewhat easy Fed policy. That was the prior peak of the actually last two cycles. So post the tech bubble bursting, the following two cycles, into great financial crisis and then into COVID, those were the prior peaks. Now, valuations went to insane levels during the COVID boom. So you had valuations go up to a peak of about 23, 24 times earnings on a forward basis. And that was because of one thing and one thing only, ultra loose liquidity. So when we look at the Fed, in that period, what justified those valuations? It was the fact that money supply was growing at a peak of 20% year over year, unprecedented growth, like that really unprecedented growth. The balance sheet was expanding by $5 trillion as they were doing quantitative easing. They got interest rates down to the zero lower bound of the Fed funds rate, and the real interest rate, which is just, we'll use the 10-year minus the inflation rate, was down to -1%. That means money on real terms was more than free. When money is more than free, you can bet on anything. You're willing to be as patient as anything to make big bets. So that's why growth stocks, long duration stocks, bubbly, speculative things did really well. So where we're seeing challenges for this market is that if we look at that liquidity scenario, it could not be any different. The Fed funds rate is nearing 5%. The money supply is now shrinking by -1% on a year-over-year basis. The balance sheet set to contract by $1 trillion this year, and real interest rates are marching their way back up past 1.5% on the positive side. So if we're thinking about how much we want to pay for this market, we don't think prior cycle highs is the right valuation when all things are said and done, which is why we continue to have to kind of put a bow on everything, is that this disciplined approach, which is that when we see markets get weak, we see fear kick up, people get scared. That's when we are buyers. We actually, my first paper I wrote when I joined NewEdge said 3,500 to 3,600. That's it. look for that. And at the time it was wild because it was so far below where we were. And I don't know if my folks were really, I don't think that they had accepted signing up for such got labeled as a bear. But we're buyers on weakness, we're buyers on fear, but we're patient on exuberance and patient on high valuations. So we're not chasing the market higher. We don't think we're at the beginning of a new bull market. It doesn't mean that we have to have the dire scenario of 3,200 or below. We may not retest that 3,600. It's possible we don't, but we would be cautious given the fact that valuations are so high at today's levels.
Where do you think the buying opportunity is going to be? At what multiple do you think we can start to consider getting back in?
It's interesting. The multiple bottomed in 2022 at about 16 times, or like 15 and a half times. This is about as low as it got. So that could be the market saying anything below that is just too darn cheap. Of course, there's always, it's interesting. There's always two components to the progression of valuation multiples. The first one is driven by fundamentals. So I talked about interest rates and liquidity. So that the first half of the move is driven by fundamentals, but the second half of the move is always driven by emotions. And that's when you see people put really low multiples on really low earnings because they think the world is ending. Now, I don't think that we have the makings right now of a big debt crisis, meaning that balance sheets look okay, whether you're looking at corporates or consumers. So that would lead me to say that we might not get that oh crap moment in the market where you trade down to 10 times earnings like you did during the great financial crisis. But even at 16 times, that's actually just shy of long run average. And it's just slightly below the average prior to the COVID bubble. So when we remove that outlier period from the average calculation. So that seemed to be where the market settled out. I would respect that and say, you know what, my forward returns still look a lot better, even if I'm buying at that valuation versus buying at almost 19 times. And so I think that we'll see how things progress. The theory is that there's still a lot of money on the sidelines looking to step in and be buyers. So, that's where the bullish argument will come in and say, yeah, like maybe fundamentally it does make sense, but flows are flows, so don't fight them. We'll see. We'll see how the year progresses. I think a lot of it depends on the interrelation with the bond market and interest rates, and eventually equities will wake up to that, I think.
Yeah, and the recent job data and inflation prints have shown strong indicators that the Fed is going to continue to raise rates a little higher, maybe and keep for longer. But how much higher are you thinking, and for how much longer?
Yeah. I think it was Raphael Bostic who was asked, how long do you want to keep rates high? And he responded with 3 words: a long time. So I don't know what that means, but it sounds like a long time. This is always the key in all of this is not necessarily having the right prediction and knowing exactly where we'll end up. It's knowing when the market is convinced of one thing, and then it's not even going to take a lot to force them to move in the other direction. And what I mean by that is that we may not know the actual end terminal rate. We may not know exactly when the Fed starts cutting interest rates. But as of end of January, the market thought that the terminal rate was going to be 4.83%, which is below the Fed's own target, and that the Fed would start cutting interest rates rapidly in the second half of 2023, which the Fed said absolutely not. So it was our view that the bond market was pricing in an incredibly dovish, incredibly accommodative scenario, which would mean that in order for that to become even more dovish, even more accommodative, the Fed would have to outdove an already dovish market. And so the end result has been this absolute whipsaw in pricing over the last 2 weeks, where you've seen the bond market go, oh, wait, okay, oh, we got you wrong, I think. And so you've seen this huge 50 basis, this is unprecedented unprecedented moves in like the 2-year in a very short period of time. So what that means to me is that now market pricing is getting a little bit closer to reality. And so, it means that, okay, we're seeing upward pressure. I would bet the terminal rate starts to creep higher. It all depends. One thing to remember, we get one more inflation print and one more employment print before we get the next Fed meeting, which I think is on the 22nd or something like that of March. So we get more data points. If the data continues at the cadence that it did in January for the February month, the Fed is likely going to point to an even higher terminal rate, and likely you'll see the dots in the dot plot for 2024 edge higher as well, which means upward pressure on the 2-year, upward pressure on 3-month, 6-month T-bills, and possibly upward pressure on the 10-year as well, which just means downward pressure on equity valuations. That's a bit wonky. I apologize. If you want details on it, I'll put you on the distribution list and we'll explain it all. And I didn't think that I was going to do like Fed bond stuff today, but here we are.
Yeah, and the Fed's had a bit of a spotty track record over the last 1.5, 2 years. Do you fully trust the Fed, and do you trust that they're going to make the right decision? And also, the Fed knows that the market reacts very quickly to their sentiment and what they're saying. How much of this do you think could be like a balk, or are they serious about staying higher for longer?
The Fed is very afraid of, I call it, repeating the sins of Arthur Burns. So Arthur Burns was the Fed chair in the early 70s. And he was the Fed chair when they first started doing like core inflation adjustments. So they started saying, oh, let's not look at food and energy and the inflation. Let's exclude that. And we'll have it in headline, but core, let's see because it's too volatile. But he also, in the early 70s, post the OPEC oil embargo, you saw oil prices rise substantially, causing inflation to rise. So the Fed raised interest rates a lot. But then unemployment started going up. And so then they cut interest rates, and then inflation came back and they had to raise interest rates. Then they cut interest rates. And the policy is called stop go policy. And it's considered by a lot of folks to be the reason why the inflationary episode of the 70s became so entrenched, essentially taking exogenous inflation variables like oil, energy prices, and creating them to be endogenous, meaning part of the system. Inflation became part of the system. That's the wage price spiral. That's how things kind of build on themselves. So when the Fed is looking at inflation as a risk, their big concern is inflation expectations and inflation becoming entrenched. So going from something that's exogenous like COVID shocks to becoming endogenous, meaning that it just doesn't go away. Because as soon as inflation goes from the interest rate sensitive sectors or things that are completely outside of the Fed's control, like oil prices or food prices, as soon as they start creeping into services and creeping into other goods prices, that's a lot harder for the Fed to control. And that was the big mistake of the Fed over the course of the last couple of years, which is that they looked at the pandemic impacts and said transitory, because look, eventually supply chains will heal. Nature heals, as the meme goes. The problem is they were right about that part. Like supply chains did heal, and durable goods prices, where most of the pandemic impacts were, reached a peak of 20% year over year in the CPI back in February of last year. They were now down about 1%. So that's disinflation. It's already happened. We've already seen it. And so that's the pandemic era transitory inflation. That's behind us. The problem is it metastasized, it spread, and it spread to other parts of the economy, where now we're seeing broad-based inflation in a way that's much harder for the Fed to control. So that's why the Fed, when we think about them blinking possibly and saying, let's step in and support markets if markets freak out, the problem is they're afraid of inflation coming back. Let's say we're in a world where inflation does moderate, but the employment market stays tight and the economy stays strong. Why would the Fed cut interest rates? Clearly, their interest rate policy isn't causing growth to slow down. And what's the one thing that they would risk if they did? That they would reignite inflation. Imagine throwing liquidity at a full employment economy. And since we're still well below the NAIRU rate, the natural rate of unemployment, meaning some kind of neutral rate of unemployment, we're so far below that. There's still so many job openings and jobless claims still, initial jobless claims still remain so benign and muted. I think it's really hard to make the argument that the Fed would want to take that gamble, because they will be afraid that inflation comes back if they prematurely ease policy. The two phrases that the Fed keeps repeating is, we will keep at it till the job is done. That's them saying we will get to restrictive. And then history warns against premature easing of policy. That's, we're afraid that inflation will come back.
Love that. Well, one, thank you so much for answering his questions and giving your insight. We do have a few questions, some from our online audience, but I'm sure there's some students here who would like to ask some things themselves. So with that, I'm going to hand it back over to Dr. Walkup to moderate the Q&A session. Cameron, thanks again so much.
Thank you.
All right. Thank you so much, Cameron. I know everyone here found that very insightful. Sorry, I don't want to drop Loveland's computer here. So we have our first question is coming from the virtual environment. And so it was asked, hello, Cameron. I also completed my undergrad at Rollins in music, and my wife shared how she used to love dancing with you at Annie Russell. I found it interesting how you mentioned the advantage of balancing your logical skill sets, being analytical, with your artistic skill sets and performance. Can you share a specific moment when your artistic background helped you succeed in a world of numbers?
Yeah, look, I think the first time that I ever did TV, it was in 2020, so it was at home, and I was so scared. I mean, I was shaking, I was sweating. It was like the middle of the summer, and I was texting with a good friend of mine, and she's like, how are you doing, are you ready? And I was like, I'm so nervous, like, what if something goes wrong? And she's like, for everything that you did on stage and what you were able to like brush off and shows and all of this, that this is natural. And I that is the truth, which is that I have, I was able to learn how to control my nerves by dancing on the Annie Russell stage, learn how to get peak best performance when under pressure. Because when the lights are on and I'm in studio and you have tons of noise around you on the New York Stock Exchange and everybody's screaming and yelling and all this stuff, you have to zone it all out, just like you're on stage, and focus on what's right in front of you. So it truly is, I think, a superpower that I got from having the experience on the stage. And I often get asked, like, do you get nervous? Of course, I get nervous every time, but it's what you do with those nerves. Do they make you better, or do they cause you to freeze? And believe me, I've frozen. I've gone, I don't remember the question you asked me. I'm so sorry. Can we go back to it? But you just keep moving. And that's what it is in the dancing as well. You will fall, you will slip. I mean, I have face planted multiple times on stage in front of lots and lots of people, but it's how you get up. And I think that's the lesson of being a performer.
Wonderful. Yeah, I know we've always heard those little bit of butterflies going into the performance help you improve. So I'd love to open it up to those that are here with us in person. Do we have any questions from the audience here? Go.
Hi, Cameron. Thank you so much for coming and speaking with us today and sharing your sentiments on the market, and then your transition from Rollins and Crummer to the new position that you're in at NewEdge. I had a quick question on some of the mentors that you maybe had over your career and how they've helped you, build your skill set and advance into the position you have now as a Chief Investment Officer.
Yeah, I think I remember an early mentor said to me, you get your CFA, do the CFA program, because that's how people will take you seriously. And it's true. I learned a lot from doing that examination. So if any of you are serious about being in the financial realm as an analyst, a research analyst, the CFA gives you the skills you need in order to do that. The other, I've got great advice over the years. I remember one of the Crummer alums gave me the advice of creating a portfolio when I went in to do initial interviews. And so I would take the resume, but include a work example and a letter of recommendation and bind it all together and leave it for the people I was interviewing with or meeting with. Because I was coming from Orlando, Florida, from Rollins, and I was outside of what I call the recruitment bubble. And I remember going and meeting with a very large bank. Somehow a friend of a friend knew somebody and met with one of the big investment banks. And the guy sat me down and said, look, like what you've done is impressive, but just so you know, nobody will take you seriously here because of where you went to school. And I was like, oh, okay, well, I definitely don't want to work here then. I probably won't fit in, but I realized that you have to seek out people who have open minds, but I realized early on I was fighting an uphill battle. But that means that I had to work harder, be better, have something that stood out and was different because it wasn't coming to me. And you know what, at the end of the day, I think that the reason why I've gotten to be able to be in such a unique position and not just be yet another, investment banking analyst and kind of slowly marching my way up, is because I come from a different background, because I come from having a unique skill set and a different perspective. And so it's like, I said it in the question about women. You seek out where you're different. And I think that kind of geographic diversity is really important. And I know that I try when I'm looking for analysts and I'm looking, to hire people, I want people who came from outside of that bubble because they have a different perspective. There's lots of the bubble here in New York, believe me. And so I know it's hard. I've been there. And I think as alumni and alumni on the line, it is our responsibility to help open doors for students that are coming out of Rollins and Crummer, because it was because of those alumni that opened doors for me that I am where I am today. If it hadn't been for people like Luke Brown, who opened up their entire network to me when I came up to New York, and invited me to Thanksgiving dinner with his family, so I had a place to go when I first came up here. If it wasn't for people like that, I would not be where I am today. And I would hope that I can be that for future students, because we have, we've earned our position to work up here, and we need help. We need help opening doors, because we don't necessarily have doors open for us in recruiters coming directly to us.
All right, wonderful. Lost my spot on the queue here. All right, so the next question comes from our virtual environment, and it says, Cameron, thanks for the time. I would like to ask you, is there anything you wish someone had told you during your career journey? And if you can share some key turning points in your career.
That's a really good question. Maybe I'll have to think about that. There was a point when I left Bank of America. It was really, really difficult. I loved my team. I was covering industrials. We were a page one shareholder on all of the companies that I covered. I got access to amazing management teams. I mean, I was sitting across the table from David Calhoun of Boeing 2 weeks after the 737 crashes, like getting that kind of access to management teams as this like young whippersnapper. I was like, this is the coolest. And I knew that I wanted to move more broad in my work. I wanted to be more than just an industrials analyst. I wanted to be a market strategist. And it was moving slowly at Bank of America. They were giving me opportunity, but it's a big ship, and it's glacial in its speed. And I got this opportunity to step into a senior role at a much, much smaller company. And I said do I give up everything that I've built in equity at this large firm, meaning, the organizational equity of all the relationships that I had in order to pursue this? And it was really scary and by far the hardest decision I've ever had to make. And it was sort of a like betting on yourself of, do you think that you can make a big enough impact and kind of really take advantage of a platform, which not a lot of people knew about it, and turning it into something great just by the amount of hard work you put in. And I did, and I made that jump. And of course, like when that business ended up going through a bunch of turmoil over the last, or after a year and a half of being there, I was like, oh gosh, like did I make a mistake? And I look back and I say, absolutely no. And the great thing about it, and probably the best advice I can give to anybody, is that relationships last a really long time, meaning that when my prior firm had issues and I was looking for different work, I called my old bosses at Bank of America who said, we'll make room for you if you want to come back, but we want to help you, to go into into an even higher opportunity, which is what I was able to find. But they wrote recommendation letters for me and they were supportive. And it's those relationships that never leaving people with a bad taste in their mouth and doing everything you can in order to keep those relationships alive, because the world is a really small place and life is a lot shorter than you think. And I've just been so fortunate to have people be supportive of me through my career. And I think part of that is always taking the long view in relationships, no matter what, always being kind, always being respectful, because you never know when people are going to, to come back into your life. And at the end of the day, it's far more fun when, to be kind anyway. So not that I think it really is key in this business to keep those relationships alive.
Absolutely. Great advice. I believe we maybe have time for one more question. JB.
Hi, Cameron, JB Adams. Good to see you again.
Hi, JB. Good to see you.
Hey, everyone here may not be aware of this, but 2 years ago, you and I had a conversation for Crummer Connections. It's still up on YouTube. And I'm going to reveal something that you and I discussed that is probably not in the interview. And that is that at the time, it was late 2020.
Yep.
You and I discussed multiple times the possibility of you moving in to media and being more influential and how much you wanted to do that as part of your career. So what I'm curious about is, in the past 2 years, what have you learned about what it takes to be media ready? What are some challenges you faced? What tips would you have for anybody who wants to make this same kind of transition?
I remember that you cut that out from the interview because it was sensitive. You're like, it was when I was still at Bank of America and you said, what do you want to do next? And I said, well, my goal is to be a strategist and do media. That's what I really like to do. I just don't know how it's going to happen. And I think it was quite literally a month and a half later that I got this role. I got the prior role as a chief market strategist. Just as an aside, I did I had written down at the beginning of that year, kind of in a goal setting, and wrote down, I said, I want to become a chief market strategist and go on TV frequently. And 9 months later, it happened. Like at the beginning of the year, I had no plan whatsoever. And then at the beginning of 2022, I had written down, I want to become a chief investment officer. And 4 months later, that happened. So I don't know if I have like a magic notebook or something. None of you guys can have it. But the lesson on the media is always be prepared. It's the only way to have peak performance and not let your nerves get the best of you. The only times I've ever wobbled is when I felt like I wasn't going in, having all the things of preparation ready and raring to go. So even if it's an off chance that it comes up, like I mentioned earlier before we joined the call, was they said to me this morning, can you talk about Cisco after the close? And I should have known, and I had to say no, I can't. But usually I would know. But that preparation is very key. And I think I'm still early on in this process of building out the media side of things. I'm very, very fortunate to have the support of CNBC, Fox Business, Bloomberg. They have been so incredible to me. People are nicer than I didn't know what I was expecting, but people have been my champion and super supportive and really fun, and like getting to like dance to like funk music before we go on air. Like it's so cool. And really there, it's all about relationships as well, because I know that, you know, for example, CNBC asked me for next week, doesn't really work. I have to change a flight in order to do it and miss another commitment, but I do them a solid, and that really helps build the relationship. So that way we can, you know, we have that for hopefully what will be a long time. So I consider myself the luckiest person in the world to be able to sit in this seat and have this position to be able to speak to the world. It's the coolest thing ever. And probably, oh, the last part is definitely don't read the YouTube comments. Just don't do it. Don't read Twitter comments, don't read YouTube comments. It never helps.
Well, it sounds like you really found the genie's bottle with that magic notebook, and we hope there's a lot of wishes still left in it. We're very proud to see what you've been able to accomplish during your career, and we'd like to first of all just say a huge thank you to you for taking this time out of your busy schedule.
Thank you. Thank you all so much. As I said, this is a huge honor, and I'm so grateful for the opportunity. So thank you. And please reach out. Any of you, just connect with me on LinkedIn. If you want to get on the distribution list, let me know for little market musings. And if I can be of help to anybody, please reach out.
We are beyond appreciative of that, and we would love it if, you know, hopefully you're in the Winter Park area sometime in the near future, and we can thank you in person.
Yes.
Thank you again so much for your time, and I'd like to also thank Davis for moderating today. Did a wonderful job. Token of appreciation. And so I realized that at the very beginning, I kind of failed to introduce myself. I'm Dr. Walkup. I'm one of the finance faculty. As Cameron said, if you have any questions, any follow-up following this, feel free to reach out to Cameron directly. You can come to me and I can help get you in contact. If you have any questions about Crummer or anything that we can assist with, we're obviously here and would love to chat with you. But we'd again like to thank everyone for their time joining us today, whether you're virtual, in person. And again, a huge thank you to you, Cameron. We really appreciate it. And it was very insightful, I know, to everyone that was able to join.
Thank you
Thank
so
you
much.
guys. Enjoy the rest of your day, and we hope to see you again soon.